All right. Joining me is Corey Hoffstein, CEO and Chief Investment Officer at Newfound Research. He's also one of the co-founders of the Return Stacked ETFs, currently 7 ETFs, nearly $900 million in assets. That includes their most recent launch from back at the end of May, the Return Stacked US Stocks and Gold/Bitcoin ETF, ticker RSSX, which I can't wait to hear Corey's thoughts on Bitcoin in a portfolio. But I will tell you, beyond owning that Bitcoin exposure via an ETF, Corey is, I think, much more well-versed in crypto than some people realize. He's not just some TradFi quant investor. And so, Corey, welcome to Crypto Prime.
Nate, thank you for having me on. I really appreciate the opportunity. Yeah, I do. My day job is traditional finance quant. I will say I do moonlight as a crypto degenerate and have for the last several years. It's an amazing space to try to keep on top of, as you and I were discussing before the show starts. It moves so fast, and if you blink, it's in a totally different direction. So it's a really fun place to continue to explore and stay in touch with.
Yeah, so like on a spectrum from TradFi quant investor to crypto degen, where do you reside? Or is that like two completely different axes?
I think it probably depends on my mood of the evening. I mean, the reality is I got into crypto through the traditional finance path, which was a lot of the ideas in TradFi, especially quant TradFi, were easily portable to crypto once the centralized exchanges got up and running, once you had perps, a lot of the DeFi, like a lot of arbitrage was very easy, cash and carry trades were very easy. So there's a lot of stuff that was very portable and very profitable. And so for me, it was just, well, if there's money to be made, let's go make money. And then once your money's on chain, I hate to say it, it sort of becomes a little bit like playing with casino chips or Monopoly money, where you're like, well, this isn't real. And then you just keep exploring and falling down the rabbit hole. So, I try to keep it above board as best I can, but there's certainly times where, I've had fun gambling in the casino. I'll leave it at that.
Well, I'm telling you, I'm looking forward to this conversation because we have connected multiple times in the ETF world, right? We've been at several ETF events together. I remember doing Bloomberg's ETF IQ with you several years ago. You've been on my ETF podcast a few times, but we have only connected once on the crypto side, which maybe I'll tell that story a little bit later. It's slightly embarrassing for me, but look, you do now have an ETF that bridges both of these worlds because it does offer Bitcoin exposure. And so let's start with that, and then maybe we can get back into a broader discussion around crypto. So tell us more about the Return Stacked US Stocks and Gold/Bitcoin ETF. What does this do?
Yeah, so to try to keep it really basic, for every dollar invested, RSSX is going to try to give you a dollar of US equity exposure, sort of as passive market cap weighted exposure as we can, not doing anything active on that side. And then at the same time, also give you a dollar of a gold Bitcoin strategy. And that gold and Bitcoin strategy is very basically designed where it's going to try to give you exposure to both gold and Bitcoin in a risk-weighted exposure. So, if gold has a volatility of 20% and Bitcoin has a volatility of 80%, you'll hold 5 times more gold than you hold Bitcoin in the portfolio. And as those relative risks move around, their relative weights will move around to adjust to it. But the really powerful idea here is the return stacking component, in my opinion, which is, again, we allow you to get access to both gold and Bitcoin through this risk balance strategy as an overlay, rather than having to sell stocks to make room for gold and Bitcoin in your portfolio.
And so with that return stacking concept, I know I always ask you the same question every time we talk, but I think it's good for people who are unfamiliar with this. Just explain in more detail why someone would want to consider return stacking. Like, what are the potential benefits here?
Yeah, so the historical way of getting access to diversifiers in a portfolio is a process of addition through subtraction, right? Most people start with a portfolio of stocks and bonds. And if you want to own gold or if you want to own crypto, you have to sell some of those stocks and bonds to make room. And that creates a problem, right? Which is, well, what am I selling? how much of it am I selling to make room? And what are the trade-offs, both from an expected return perspective, right? If I'm selling stocks to buy gold, for gold to be additive or Bitcoin to be additive, it has to outperform the stocks I sold. There's an opportunity cost there. But there's also a behavioral risk, right? And this is especially true for traditional finance allocators who are very centered around stocks and bonds, that when they sell their stocks and bonds to make room for diversifying alternatives, when those diversifying alternatives zig and zag at different times in the core stocks and bonds, that can be very uncomfortable, particularly if they do so, if stocks are going up and gold and or Bitcoin are going down, right? That can be particularly painful and hard for them to hold on to those diversifying allocations. And so what return stacking does is it takes this idea from the institutional allocator space called portable alpha that says, well, instead of making room, what if we find a way to effectively stack those exposures on top? So I don't sell my stocks and bonds. I maintain that core stock and bond exposure, and I layer those alternatives on top. So for every dollar I invest, I'm getting more than $1 of exposure. This is inherently using leverage to achieve that, but using leverage to introduce diversifiers to the portfolio that hopefully allows you to unlock those diversification benefits without running into all the behavioral frictions that we typically get when we try to introduce diversifiers to a portfolio.
And you mentioned the leverage component there. You're getting this leverage through the use of futures contracts. And I know we've discussed this in the past as well, but when some people hear the word leverage, they automatically think risk. And I'm not saying that's what they should think, but that's how a lot of investors and advisors view leverage. It's just more risk. So talk about that. I thought you laid out the return stacking concept well, and that plays in obviously to this question, but just talk about that leverage component.
Yeah, I mean, look, people have, I think, a very good reason to be skeptical and concerned about leverage. If you look at every major financial catastrophe, leverage is at the scene of the crime most of the time, right? But it's usually not there alone. It's normally there with illiquidity and concentration risk. Leverage is just an amplifier of both good things and bad things. And so when you look at using leverage to help increase the diversification in your portfolio, we think that's a really good use of leverage versus increasing the concentration, right? We're not saying, hey, young, aggressive allocators, if you have 100% equities, you should go 200% equities, right? That's doubling down on the same risk. What we would rather say is, well, instead of being 100% equities, can you be a mixture of stocks, bonds, gold, Bitcoin, right? And then lever that portfolio up to the appropriate amount of risk that you're willing to tolerate. And now you're more well diversified across things that are going to zig and zag at different times, but you're still getting to the same appropriate risk level. And so I think leverage is a tool, and it's a tool you need to be thoughtful about in its use. And leverage used to unlock the benefits of diversification, I think, is probably the best use case. And the example I would point out there is, I think, the very famous Bridgewater All-Weather Fund, right? That uses a tremendous amount of leverage to diversify across assets all around the world in a risk-balanced manner, and has a very strong track record of surviving major financial catastrophes because it's so well diversified. And that leverage is what allows it to maintain that diversification, but still be at an appropriate risk level where the returns are appealing.
By the way, I should know this. Did you actually coin the term return stacking, or is that attributed to you and your team formally, or where did that come from?
It is attributed to my colleague Rodrigo Gordillo. I wish I could say I came up with the phrase, but it was Rodrigo Gordillo at Resolve Asset Management who came up with it. And once he said it, it was like, that this is it. Trying to find a way to describe what we're doing is not trivial, right? And again, I mentioned it's this idea of portable alpha in the institutional space. What does portable alpha mean? Hopefully return stacking at least is a little clear, where you say, all right, they're stacking returns on each other. Like, that sounds pretty additive. And if you can think of just the addition of A plus B, right, that's sort of, you can work through the scenarios where it works in your favor and where it doesn't pretty easily, hopefully.
All right, so this is obviously a crypto podcast. Let's come back to the Bitcoin allocation and RSSX. And I really can't wait to hear your response to this. I just want to hear what you see is the value of owning Bitcoin in a portfolio. Is this like quant stuff where you're just looking at the numbers and you like the risk return profile of Bitcoin, or is there more to it here?
Yeah, so I'm gonna answer this question by completely ignoring your question at first. I promise I will come back around to it. But when we were originally designing this ETF, it wasn't originally around necessarily including Bitcoin. What we were looking at originally was gold, right? Gold is this really interesting asset class. It exists outside of any sort of political jurisdiction. It doesn't have credit risk associated with it. It's got a very limited inflation rate. It historically has exhibited negative correlation to the US dollar. And post peg period, post 1971, it has had a positive risk premium associated with it. In other words, when you hold it, it has tended to appreciate in value. And so as an overlay to a portfolio, especially for a US investor, it has some potentially very appealing properties, right? It hedges your US dollar risk, whether you think there's a devaluation risk of the US dollar, or you're simply trying to hedge your home bias exposure of you don't have exposure to other currencies, right? That's really powerful. Effectively, you're denominating some of your assets in gold when you add it as an overlay. But that hedge, that gold hedge against the dollar, has historically paid you. And that's very unusual for a hedge, right? So that was the sort of inception of the idea. And then as we were thinking about bringing this product to market, we said, gold has been this thing that's been around for millennia. Bitcoin is, and I will probably offend both gold and Bitcoin people when I say this, but Bitcoin is in many ways designed in the same spirit of what gold has historically achieved. It is, for lack of a better phrase, digital gold with some very unique properties, right, that differentiate it from gold, but a significant amount of overlap that going forward means that Bitcoin could serve very much the same role, right, where it's this asset that exists outside of any political jurisdiction. It doesn't have any associated credit risk. It is a bearer asset. It doesn't quite exhibit all the same statistical properties gold has, but it's still much more nascent in its adoption curve. But we are seeing it adopted for many of the same reasons gold has been historically adopted. And so we said, as we're building this product and trying to think towards the future, it seems very obvious that if we want to have gold for these properties, having Bitcoin as well makes a lot of sense on a look forward basis. And so then it was a question of, how do we combine these things together in a way that is adaptive, right? The Bitcoin experiment could fail, or it could succeed wildly, right? Again, it's still early in the true global adoption sense of where Bitcoin could go. And so how do we make sure that we're not locked into a portfolio design that doesn't adapt to those realities?
So, a couple of things here that I want to ask you about. First, do you then view Bitcoin as digital gold, or is that too simplistic?
So, I'm going to steal a turn of phrase from our joint friend Dave Nadig, who I don't know if he came up with this, but he's the first one to introduce it to me. Is this idea of what's called a psychological commodity? Gold is a psychological commodity in large part, which means its value derives from the fact that we all collectively agree it has value. Gold has very little industrial use. I think 10% of the annual mining supply goes to industrial use. 40% goes to jewelry. 50% goes to investors and central bank purchases. And I would argue that the 40% only goes to jewelry because people think that gold's going to hold its value for the same reason investors just outright buy bars of gold. So, but why should gold have value? We just all agree it does. Like, it has a lot of nice physical properties of why we chose gold rather than silver. But you go to different countries around the world, and you'll find that not everyone used gold as their currency, right? There were seashells and rocks and all sorts of other things that were used as currency. Gold did ultimately proliferate as Europeans took over the world, particularly finding gold in the New World really ushered in a new era of gold. But gold has value because we all accept it has value. That's really, I hate to say it, that's the only reason. Bitcoin, this will offend a lot of Bitcoin people, is the same thing. It's a psychological commodity. Bitcoin has value because people accept it has value. And there's a very easy mental test there where you could say, I could very quickly clone the source code for Bitcoin and launch a competitor. and it has all the same features, all the same properties, and it would not have any value, right? Which means that the value isn't intrinsic to the properties, it's intrinsic to the fact that people have collectively accepted that this implementation of Bitcoin has value, right? Why do the miners continue to mine? Because the price is above the price it costs them to mine. And why is the price above the price it costs them to mine? Because someone's willing to buy it and hold it with the belief it continues to have value, and they can share it with someone else or send it to someone else or sell it to someone else who will agree it continues to have value. That sort of psychological commodity, I think, has tremendous power, right? Again, we as a global society seem to value having an asset, a bearer asset that exists outside of the purview of any one geopolitical power. That's very important, and I can tie that to gold and central bank purchases in a minute. But what I think where this sort of puts a thorn in a lot of people's sides is it's very hard to distinguish between like a pyramid scheme, memes, and psychological commodities, right? Like, why Bitcoin versus Doge, right? Why is one a meme, but one is a digital gold, right? And again, I know I'm going to piss off a lot of people, I'm sure, with this concept, but the reality is, like, I think traditional finance people have had such a hard time with Bitcoin because psychological commodities in their early adoption cycles are largely indistinguishable from memes and sort of pyramid schemes. It's only when they fully survive the early adoption cycle and they're globally, culturally accepted that you go, oh, this is a psychological commodity. And it sort of like bubbles out of this meme territory. And to me, Bitcoin has already passed that point. But you'd have to forgive a lot of traditional finance people for still looking at it saying, I don't understand why this has value. Intrinsically, it doesn't. Its value comes from the fact that everyone else accepts it has value.
Okay, so then let me ask you this. When you were describing why you own both gold and Bitcoin in a portfolio, the way that I interpreted your response was that Bitcoin is almost a hedge as a psychological commodity against gold, which is a psychological commodity. Is that a fair way to look at it?
Yeah, so that would no. The way I look at it is they're both psychological commodities that are hedges to global fiat. What you tend to see historically is, right, again, gold has that negative correlation to the US dollar. That's a very strong, long-standing relationship. You also tend to see, right, gold has a positive risk premium. Bitcoin isn't there yet. Bitcoin does not fully exhibit a negative correlation to the US dollar. Bitcoin still does have some positive correlation to equities, and particularly tech equity beta, right? So it's still early in this adoption cycle where it hasn't fully moved to having the same properties that gold has. But I think it will eventually get there if it does continue along the adoption cycle. So the reason we included it was because we said there's this nascent asset that shares thematically a tremendous number of the properties that gold provides. Having two of these in the portfolio is better than one, right? Both of them are ideally, hopefully over the long run, going to diversify against fiat currency and currency devaluation risk and all these potential beneficial properties for people who are concerned about those things, but go about it in different ways. They're not really meant, they're meant to potentially diversify each other, not inherently hedge each other, though. And for us, again, the idea is, like, today, when we look at the portfolio, Bitcoin is so much more volatile than gold. We've got probably a 75, 80% position in gold versus a 20 to 25% position in Bitcoin. As Bitcoin continues along its adoption curve, we expect that volatility to decline to the point of gold. Bitcoin goes from 2 trillion in market cap to 22 trillion like gold, and gets fully adopted by institutions and is purchased in the same way that gold is by central banks around the world for macroprudential reasons. We would end up in the portfolio largely holding them 50-50.
It makes me think of our friend Eric Balchunas over at Bloomberg, who describes Bitcoin as gold as a teenager.
I think that's a great explanation. Yeah. And again,
Yeah, go
the
ahead.
properties between them are unique, right? Like the fact that gold has a 1 to 2% inflation rate per year is very different than the fixed supply of Bitcoin, and potentially leads to a very different end game. And so you can argue about those details, and they are important details, but I do see big picture, they intend to serve similar roles. And that's why I think having them both in this portfolio was important on a go forward basis.
I don't want to belabor this entire point or discussion, but you visit with a lot of financial advisors, and you know that gold has always been polarizing. I think if you were to poll whatever 10 advisors, you're going to get half that love it, half that hate it. And certainly Bitcoin, I think, falls into the same camp. What do you hear just around like how polarizing are both of those when you visit with advisors? Can you notice a difference? Or, gold's been around for, as you mentioned, thousands of years, millennia. Bitcoin's been
Yeah.
around for 16 years.
Yeah. Price predicts narrative in many ways, unfortunately. When I started my career, advisors I met with, and this was 2007, 2008, there was gold. Everyone was holding 5% gold in their portfolio because gold had done so well. It was really until the 2010s that gold hit a bear market that, as I, through the 2010s, evaluated advisor portfolios, that gold was pretty much entirely removed. Well, now they're looking to introduce gold again. And what I find is a little bit, it's that performance chasing. It's what is culturally acceptable in the zeitgeist. If end investors are hearing about gold enough and how well it's doing, it's easier for the advisor to allocate. But they're still facing this problem of, all right, I got to sell down some stocks and bonds to make room. And if gold hits another bear market while equities go up, man, there's opportunity cost, and my clients are going to be mad at me. So the amount that they're willing to allocate is always pretty de minimis, probably max 5%. Similar idea with Bitcoin. And part of the problem, and you know this all too well, was access to Bitcoin prior to the ETF was very, very difficult. Most advisors would not be willing, for legal and compliance and regulatory reasons, to advise on crypto exposure that was held away from them. The ETF now allows them, ETFs, I should say, obviously BlackRock shares being the big one, allows them to put it within their models, manage it on behalf of the client. I think we'll continue to see a proliferation of these types of exposures, but they're so high in the volatility relative to the rest of the portfolio that it's really a small dose, right? A 2% position in a Bitcoin ETF from a vol perspective is equivalent to about a 10% position in equity, right? And if you said to an advisor, are you willing to put a client in a single name stock for 10% of their portfolio? Probably not. Maybe some advisors will do it with Berkshire, but for the most part, they won't. And so it's hard for them to get above 1 or 2% in a Bitcoin ETF because the vol is so high, and they have this fiduciary responsibility, and they have to defend their portfolios, in SEC, regulatory exams. And so I think there's this inherent limitation to how much they're willing to put in, but the appetite to put it in has certainly gone up. I think there is a growing concern about the U.S. debt cycle. There's a growing concern about the U.S. dollar. We had a really strong U.S. dollar over the last decade. People are concerned about whether the U.S. dollar will continue to maintain its primacy on the global stage. And you're starting to talk to advisors who want ways to hedge that or diversify that risk on behalf of their clients, particularly because U.S. investors tend to be so dramatically overweight U.S. assets with that home country bias. We just really are not diversified into foreign currencies in any way. And so a little bit of Bitcoin, a little bit of gold helps do that. And Bitcoin in particular, right? As I said, a 2% slug of Bitcoin is like a 10% slug of equities. It's like hot sauce. You don't need a whole lot. That high vol makes it a very effective hedge in low doses. And so putting that 1 or 2% in, allows them a very capital efficient exposure from a hedging perspective.
Well, not everybody agrees with your allocation suggestion on Bitcoin. Did you see Rick Edelman suggesting that aggressive investors should have up to 40% allocation to Bitcoin and conservative investors 10%? I've always been much more in your camp. I'm certainly a Bitcoin proponent. I think that's clear. But if I look at historical data, owning, say, 5% or up to 5% in Bitcoin, and then you hit the nail on the head. you have to be disciplined too in rebalancing because of the vol, right? So if you position size appropriately and you're disciplined about rebalancing, it certainly has additive effects to a portfolio. But anyway, I'm curious, what do you think of Rick Edelman suggesting up to
Yeah, I was
40%?
surprised. I did hear Rick. I'll go back and say, well, look, Paul Tudor Jones, obviously not an advisor, but a very thoughtful allocator, said that he would think about doing a risk-weighted allocation between stocks, gold, and crypto as his sort of hedge. Not what Rick was saying, which is this is the growth portfolio, but his hedge against sort of the U.S. Debt cycle risk, right? Which kind of comes out to about 50% equity, 40% gold, 20% crypto or Bitcoin, which is sort of the unlevered allocation you would see in our ETF. So, everyone has a lot of opinions. I think it's what your end goal is. I personally think 40% in Bitcoin alone feels pretty heavy to me. And I can't imagine any advisor ever getting comfortable with that from a fiduciary perspective. But, again, if that's what people are comfortable with, I won't begrudge them their own personal allocations.
Well, that's also, I don't want to get off topic here. I'm sure you've seen these Bitcoin buffer ETFs, and they're fine. They do exactly what they're supposed to do. If you want Bitcoin with guardrails, that's great. I actually view the volatility as a feature of Bitcoin, not as a bug. But again, going back to, I'm being repetitive here. You have to position size appropriately, and you have to rebalance in a disciplined fashion. But in any event, let's move beyond Bitcoin here for the remainder of our conversation. And I mentioned at the top, Corey, I do feel like you're much more crypto savvy than some people might realize. And I hope you don't mind me sharing this, but you actually helped me claim an airdrop where I was making some real rookie moves or mistakes. I wasn't on the right chain and those sorts of things. And you quickly helped me solve my boomer challenges. So I appreciate that. I still owe you a nice bottle of rum for that, by the way.
I'll collect and we can have a nice glass of rum together at a bar sometime.
But I mentioned that because it was very clear to me that you know your way around the crypto ecosystem. And I also see you tweet crypto related topics and those sorts of things. And so I would just love to hear more about your personal level of interest in crypto and then what you see as a longer term potential of crypto overall. And I know it's a really broad question, but do you see some real use cases here, or is this just a casino, a fun place to play?
So I should disclose first and foremost personal private investments in some crypto companies, and I am an advisor to a crypto hedge fund, Starkiller Capital. So I have some both personal investment here beyond just like actual crypto exposure. I have some private equity investments and some, I advise a hedge fund that operates in this space. So I am biased in my opinion, but my view, right, is that this is a nascent technology that we don't know where it's going to go. Candidly, there are all sorts of potential use cases, right? Even if it just ends up with just stable coins being a way for us to move capital around. I had to send a wire to myself last week from one bank to another, and it took 4+ days to settle with the July 4th holiday. And I'm thinking to myself, what a ridiculous system. Where if I had done this on chain with USDC or USDT, it would have been 10 seconds. Right? There are just some things in the financial system that we can probably figure out ways to improve. Now, you have to consider the safety guardrails that are built into the traditional finance system. And, do we want to tokenize securities and get rid of SIPC and all that sort of, related insurance? Like that's a big open-ended question about risk. But there are potential ways in which blockchain technology can really expedite financial transactions and in some cases further secure them. But it splinters so far from there, right? The way I sort of view the topology of the crypto world is that you have all these psychological commodities, right? You've got Bitcoin and memes. I think Bitcoin is a survivor in this scenario. You then have stable coins, right? You've got your payment processing. You have real world assets. This is a growing space that, the tokenization of real estate and the tokenization of securities, really fascinating idea, bring those on chain. You have what I would call club coins, which is like you own them, you become part of a club, you get some non-monetary benefits. Sometimes this is like if you want to use a protocol, you get cheaper costs, or you might get a t-shirt or access to, an event. You have actual securities or phantom securities. They're not registered, but they're doing real cash flow buybacks, or they're issuing dividends in some security form. Like there are real corporate securities that are being traded on chain through these protocols. And then you have all of DeFi, which is just this permissionless financial system that is really powerful. That you sort of, when you get all this capital collected in this permissionless way and all these Lego building blocks of composability, you can build so many interesting things with all the risk that goes along with that, being the wild, wild west. But it's really fascinating to see the potential of it operating outside of the traditional financial rails. So where do I see this going? I don't know. I sometimes feel like that question is like, am I trying to predict where the internet's going in 1995? Like to me, it's still so nascent, but it feels irresponsible to not stay in touch with it. I think a lot of people just write it off as the casino. The founding partner at Starkiller Capital, Lee Drogan, says the casino is the bootstrap program. Like the casino part of crypto gets a lot of capital on chain, which allows a lot of this stuff to continue to operate. I hope it moves beyond the casino. There's a lot higher purpose for all this beyond just gambling. But I look at a lot of the early gambling as being the way of getting the liquidity on chain that allows a lot of these protocols the initial liquidity they need to survive, and a lot of these initial ideas the liquidity they need to bootstrap. So again, I don't know where it's going, but it feels irresponsible to me to not stay on top of it.
I love the way you articulated all of that. And I couldn't agree more. I like the way that you framed it is irresponsible to not stay on top of it. That's honestly one of the reasons why I'm doing this podcast. It's one of the reasons that I became interested in crypto, because as an advisor, we owe it to our clients to at least be educated and conversant in it. And we can debate investment merit and those sorts of things. I've always used a very crude example of, like, let's say you don't want to own high yield bonds in a portfolio because you think their volatility profile is very similar to equities and whatever. You have some rationale. That's great. Guess what? You're going to get questions from clients on high yield bonds. So you better be able to intelligently answer those. And I think it's very similar in the crypto sphere. Let me just ask you about one specific area that you touched on, which is the tokenization of securities. And this has been a running thread throughout this podcast. But I guess I would just ask you, like, if you had a handicap, could you envision a world where you're offering your return stack strategies via a token instead of an ETF? Is that plausible to you?
I don't just think it's plausible. I think it's potentially inevitable. I mean, in theory, right, someone could do it without my permission. They could create a smart contract where you put in dollars, they issue a token that, they then take the money and turn around and buy my ETF on exchange, right? The same way, you create and redeem for Tether or USDC, right? You can create and redeem for tokens. And someone could do that without my permission. My concern there, right, is when you're talking about the real investable assets of, people's retirement, like that brokerage protection, that SIPC, that insurance is not something I think we should trivially overlook. And unless we figure that aspect out, asking everyone to say, take all your stocks and move on chain, and now all your stocks are tokens that you have in your, hardware wallet locked in your safe, feels very irresponsible to me without there being a huge upside benefit. I've talked to some people who say, well, tokenization allows 24/7 trading. That feels inevitable. Maybe. I hope not for my career. But, it probably is eventually inevitable in terms of the way the world is going. The other thing that tokenization really allows is all of a sudden you can participate in DeFi, right? So someone can take a token of my ETF and they can do all sorts of crazy things. The vanilla part, they can borrow against it. More complex, they could insert it into a smart contract that turns it into a structured product. Or they could insert it into a smart contract that splits it into the income stream and the price return, and they can sell those two tokens off independently. And right, they could keep the price return and sell someone the income stream. DeFi becomes very powerful when you get this full tokenization. But the concern for me, especially for where crypto today is hacks are so common. There's no insurance. The security level is improving, but still dangerously low compared to what people expect with traditional, this is my retirement. These are my savings. I don't think the world is there yet, but I can certainly see it getting there.
Yeah, that's why I find this entire intersection between TradFi and DeFi so fascinating. I agree with everything you said there. You think about what Congress is attempting to do and pass various legislation around stablecoins and crypto overall, putting a framework in place. You think about the work the SEC is doing. I think you're right in that tokenization is probable in the future, but there's a lot of thoughtful considerations that have to go into implementing that, so the end investor is properly protected. They get the experience that they want and that they deserve, and it's beneficial to everybody. But Corey, I always enjoy connecting. This was fun on the crypto side. I love this. And
yeah.
Best of luck with RSSX and your entire ETF lineup. But thank you for joining me.
Thank you for having me, Nate. I really appreciate it.
That was Corey Hoffstein, CEO and Chief Investment Officer at Newfound Research. Thank you for listening to or watching Crypto Prime. As always, you can stay up to date on all my latest guests by visiting CryptoPrimePodcast.com. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit CryptoPrimePodcast.com for more information.